Hey everybody, welcome. The day before Thanksgiving. So happy Thanksgiving and happy holidays to all. Today we're going to cover where are mortgage rates going. This will be a new video segment I'm going to do every month. So this will be the November 2022 edition. So where are mortgage rates going? First, let's jump in and let's talk about what controls mortgage rates. So it's mainly the Fed rate. And the Federal Reserve has been hiking rates all year, as many know, in the fastest rate hike cycle in history. What we are seeing a little bit lately is the rates coming back down some, as many are expecting the Fed to stop hiking rates soon. But let's get into a little more detail and let's talk about what is the Fed rate and the Fed funds rate and what's the difference. So here's a chart of the federal funds effective rate. Now, the Fed funds effective rate is what institutional bankers are charging each other. So that's if your Wells Fargo does a loan to your Chase Bank, they're going to charge this rate here. It's hovering right over 3% at this time. But the actual current Fed rate is right here, 3.75 to 4%. So there's generally about a 1% difference. Now, the Fed rate is what the Federal Reserve charges banks to borrow directly from them. Okay, but these are what really controls mortgage interest rates. And then the market basically anticipating Federal Reserve moves, either a rate hike, a pause in rate hikes, or a rate cut. So mortgage rates will move ahead of the Fed in expectation of what the Federal Reserve move is going to be. At this time, the current Fed rate is 3.75 to 4%. We're just going to use 4% for ease of conversation, and the target Fed funds rate is at 5%. Yesterday, some news did come out saying that the Federal Reserve members do believe that they may need to go higher than 5. So that's not the best news, but we'll see if they can even get there. Now let's jump into the news. What's the news talking about this subject? So here's an article from Reuters. Real impact of Fed rate hikes is likely bigger than what the target rate implies. And what this article gets into is that the Fed fund rate right now is 3.75 to 4%, but the financial markets are pricing in a Fed rate hike of 6%, a Fed funds rate of 6%. So the markets may be anticipating that the rates are worse than they're actually going to get. Here's Barron's. Fed tightening is having more impact than you might think. And then another article from Bloomberg. Fed raising rates until 2% inflation reached would guarantee an overshoot in a deep recession. And I completely agree with this. The Federal Reserve is not going to keep hiking until we reach 2% inflation. But they will probably pause rate hikes and leave them higher for longer until we do get closer. One thing is for sure, they want to see that CPI number and core CPI trending down for several months in a row. And we have seen that now. The last reading on CPI was 7.7%. We peaked out about 5 months ago at 9.2%. So the inflation is coming down, but we want to see the December reading come in lower than 7.7, and then we want to see the January reading come in even lower than that one. And then we will have a true downtrend, and we might talk about a Fed pause. Now, Fed's Daily is saying it's premature to rule out another 75-point rate hike. I personally do not think they'll do another 75. I think we'll get to that 5% Fed rate by doing 50 basis points in December, and then I believe they'll do 25 in February and 25 in March, and that would get us to 5. And at that point, I believe they will stop but we'll check in every month to do an update on this information. And then here's Fed Mester. He wants to see more progress on inflation before ending interest rate hikes. So that's what we were just talking about. Now let's jump into the charts. So here's a 2-year bond yield. Okay, and what this is important is this is showing what the markets believe is going to happen in the short term over the next 2 years. And as you can see, this is a very strong uptrend here. We have a real strong uptrend. No sign of this coming down yet. And it probably won't until the Fed says that they're done hiking or that they are going to stop soon. And then you might see this start to roll over. So let's look at the longer term, the 10-year. So the 10-year is telling a slightly different story. We're seeing a really strong uptrend, of course, but what we see here is it's starting to roll over. Only time will tell if this rollover is going to be like this one here and then end up continuing upward, or if this one is going to actually trend down. But we do have a low here, a lower high here. This high is lower than this high. And then we have a lower low right here. This low is lower than this low. So that would be the start of a short-term downtrend. So hopefully this continues to trend down. It's really going to depend on what that CPI data comes in over these next couple months. We all hope that inflation continues to drop. So let's go through a summary. The Fed rate. There might be only 2 to 3 more rate hikes if inflation continues to fall. If inflation rises again, the Fed would continue to raise rates. So it is important to pay attention to the CPI data. In the news, the Fed rate hikes are already having an impact on the economy and the housing market. Watch the CPI and unemployment data. That's key. That's what Powell is watching. And then lastly, the charts. The charts are telling us that we have some more rate hikes coming in the short term, but long-term rates will be lower. So we do expect rates to come down sometime next year. The Mortgage Bankers Association is currently projecting rates to come down to about 5.5% sometime next year. I will say right now they are down about 1% or so off of their highs. So the market is already starting to price in that the rates are not going to go quite as high as we thought they were just a month or two ago. So that's great news. And thank you for joining us. Here's my contact information. If you have any questions or want any more details about this information, just give me a call. I'm happy to help you or your clients. Thank you so much. I hope everybody has a happy Thanksgiving, and we'll do another one of these videos in December. Take care, y'all.